The FIRE movement's enticing goal has made it popular among young workers. FIRE stands for Financial Independence Retiring Early. If they save and invest aggressively, people can become financially independent by 30%. This seems absurd in a society when pensions are dwindling and people may have to work forever. Trust fund kids and young tech billionaires may make millions in their first few years in the real world, but a normal wage slave can't just rest on the beach and never work again. Some celebrities and internet communities say yes. When a person's long-term investment returns exceed their living expenses, they are financially independent. Proponents of the movement say the challenge originates more from individual lifestyles than individual earnings. How does FIRE work? As they say, is it possible? The movement's economic impact is also key. If everyone retired at 30, wouldn't our civilization collapse? If we answer these questions, we'll know if this is more than a pipe dream for people who hate their boss. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. This sounds like a great idea, but if you're considering retiring at 30, you should get a firm grasp on how it all works. In other words, what are the nuts and bolts of frugality? Historical figures exist for various crucial economic aspects that allow us to predict the future. The relevant assumptions for the FIRE concept are that a well-diversified investment portfolio should have an annual return of roughly 8% and that inflation is between 2% and 3%. With this foundation, you can live off your portfolio indefinitely. Some of these numbers may alter. To give an example, if you put $1 million into an index fund, you would expect the returns to be approximately 8%, which has been the case for about 100 years on average. To put it another way, dividends and capital gains would make up most of the return on this index shares. As a result, the portfolio's value would remain stable even if you were to withdraw $80,000 each year from it. Even if you're working in a high-paying job and can't afford to save $1 million in your lifetime, you're not out of luck if you're living in a household with two individuals who both make at least $80,000. There are two considerations that make this a little more difficult than it first appears. Federal Reserve Bank of United States sets a 2% inflation rate as it aims for the country's economy. An $80,000 salary in 1960 would have cost roughly $5,600 per year in today's dollars. FIRE is about retiring early and living a long life without the need to work. So you need realistically plan for at least the next 50 years in order to achieve this goal. That $80,000 a year you're taking out of your investment portfolio would only be worth $32,000 today if inflation is kept at 2% for the next 50 years. However, if you're willing to live in a low-cost part of the US, you may find yourself needing to return to the job at the age of 70, after 40 years out of it. Keeping this $1 million portfolio's real value would need you to put in $20,000 a year in order to keep up with a 2% inflation rate. In the grand scheme of things, that's not a big deal, but it means that you'll have just $60,000 per year to live on. Reinvesting at least 3% of your portfolio's gains each year is generally recommended as a safety net for investors. The concept of dollar cost averaging is a significant one in the world of investing. Over time, the market tends to rise, despite its chaotic nature. Investing at regular intervals, such as once a month, is the best way to maximize your return on investment for 3 reasons. Reason number 1. You don't have to worry about it if you set away money and don't think about it. Therefore, this is a big benefit. Make sure you don't get caught up in the latest fad or the market's lowest point. Reason number 2. Putting your money to work right away is reason number 2. If you wait a year or until you've done study on a specific stock or whatever, you'll miss out on market time and potential returns. The average annual market return is 8%, so delaying your $10,000 investment would put you behind $800 behind a person using dollar cost averaging. Time in the market trumps market timing in the abstract. Lastly, and by no means least, we have the most important reason. Buying low and selling high are the keys to successful investing. In a sense, you're already doing this by investing on a regular schedule. For example, if you invest $1,000 a month into Walmart stock, the amount of stock you buy will depend on the share price. For example, if a share costs $100, you can buy 10 of them for that price. While it is possible to buy 20 shares a month for $1,000 if the price lowers to $50. It is also possible to acquire just 5 shares if the price rises to $200 per share. If this hypothetical investor had followed a consistent investment strategy, they would have won at least one side of the buy low, sell high debate by purchasing more shares when they were less expensive. All of these advantages of dollar cost averaging on the buy side have the disadvantage of being disadvantages on the sell side. Selling more shares when they're cheaper than when they're more expensive is a natural consequence of someone withdrawing $5,000 per month from their portfolio to cover their living needs. Many in the fire service work around the 3% limit for these and other reasons. A starting point of an 8% projected return is deducted for inflation, the effects of negative dollar cost averaging, the volatility of the market, and 1% for the margin of safety. If you can live off 3% of your investable net worth annually before taxes, you are financially independent and will remain so for the rest of eternity. All else being equal, regardless of inflation, you'd need $3.3 million in investments to live off $100,000 a year, which isn't a lot of money. On the macroeconomic level, this is all fine and dandy, but if this actually takes off, it's impossible to sustain. What would happen if there were no workers in the world? Human work is critical to a functional economy and society. Here's something to ponder. Somebody is earning a living and putting aside half of their earnings. With that money, they buy a farm, build a workshop, and have machines grow and collect crops for them. A mine with basic materials and even robots is also built, along with metal harvesting and refining facility. They have a state-of-the-art workshop where they can build anything from scratch. Assuming no land taxes, this person is self-sufficient. This possibility may excite ranchers and other off-grid inhabitants, but fire practitioners do something similar. Our workers only bought land or capital things like machines or technology. Investing in things to produce commodities and services for oneself is an example. Real people invest in something that benefits everyone. They'd charge everyone who wants to use their productive potential a fee, which they distribute as dividends to shareholders. Financial independence allows one to speed up the labor-intensive process of living off machines and land. Would widespread fire adoption hurt the economy? Reducing consumer spending and rushing to financial markets would cause short-term instability, but this is also theoretically plausible long-term. And now for some final thoughts. Fire isn't for everyone. Many believe that cutting one standard of living isn't worth a few years of career. Thinking about purchases in terms of work hours may help you resist overspending. There were 70 hours of team meetings for the new iPhone, 30 hours of Excel macros to pay for the new outfit. Many may not find this worthwhile. It's just that some who don't believe in investing are afraid to start. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.